Good afternoon, everyone, and welcome to this market briefing webinar. It's the first quarter of 2026, and it's been a remarkable year. So we'll try our very best to put some context into this. Because it's so complicated, I've drafted in help, and you will recognize my colleague Vijesh, who's joining me in taking you through the presentation. Vijesh and I have been working together for 8 years now. We've been trading together quite actively, so he's a bit like the yin to my yang. And we look at these things on a daily basis. So hopefully that familiarity will come across well in the webinar and you enjoy the change in format. As always, we'll look at this quite systematically. We'll look at the market drivers, which are always the same. It's inflation, growth, earnings, and geopolitics. We'll then look at performance by going through the main benchmarks, seeing how things have turned out. We don't just focus on a quarter. We always try to give you perspective with different timelines just to make you aware of the big trends in the markets, a bit of a value add for you. And then finally, we'll wager an outlook by looking at graphs that make you go, in the sense that many of them depict quite long-term histories or historical breakouts of some sort. In other words, they're all quite interesting, these charts, and they all make us sort of think about where things are going. We'll also look at quite technical things like positioning or cash levels, all to give us an indication of where these markets may turn. As you know, we only focus on the financial markets. We don't do anything private. We like the fact that there are daily prices. And from these prices, from all these different asset classes and instruments, we can interpolate what the market thinks of the current situation. And that's really what this is about. So without further ado, we'll give it a shot and start. And the market drivers this time around are all about geopolitical risks. So when you look at this graph, Vijesh, of the map in the Middle East, what strikes you?
Well, yeah, no, there's what's clear is that obviously there's two very narrow straits here, and there's a lot going on. So you have obviously Iran, but then you also have their proxies and the likes of Hezbollah in Lebanon. So you have Hamas, and then also the Houthis in Yemen, who have recently also started stirring something up as well. So these two straits, obviously the Strait of Hormuz is very important. It's prior to the war, it was where a fifth of global oil supply went through. But then you also have the Bab el-Mandeb Straits down on the bottom of that right there, which is also very important for oil as well. And that's where I think around 7-8% of oil also goes through, and it's become even more important given the war, as with the Saudis rerouting a lot of oil from the Strait of Hormuz to the other side. That is now where that oil passes. So there's a lot going on, and geopolitical risk clearly is a big threat to oil supply.
Seems to be the only thing that matters. So without taking any view on this, it just looks complicated. So there are three paths really from here. One is that we get this diplomatic resolution, which seems to be what the markets are now pricing in. Two, becomes a stalemate, and it gets prolonged. And then three is, all-out war. Will probably pull in, other parties, and the whole thing turns into a big crisis. So very complicated, not just in terms of geography, but also in terms of the factors going into the debate. So, there's only one thing to do, and that is to ask ChatGPT what might be the outcome of this. And this is what we got back. Now, this took several iterations. And I guess the main takeaway from this is that, we don't know what this says at all. So in other words, if the AI can't figure it out, then it's probably also not up to us to figure out where this is going to go. So probably worthwhile to just check the actual effects of this war. And this is where it gets really interesting. Vijesh, this is a frightening chart. What do we see here?
So this is the expectations for inflation in the US, which is made by the Cleveland Federal Reserve Bank. And what you can see here is from early March, where the conflict really kicked off, there's been a huge spike in inflation expectations. That's up over 1%, and that's all on higher energy costs and fertilizer costs, basically everything that goes through these important straits.
So not good. growth in the US has not really, had the effects show up yet. We're also at the beginning of earnings season, so we'll see whether companies will wager an outlook here. But so far, this is ISMs, right? So the ISMs is anything above 50 is positive, and anything below 50 is negative, right? So far it's all good. I mean, obviously we're lower than in these beautiful days of 2022 when we were throwing trillions of dollars worth of stimulus at the markets. So we have come off from there, but we're still looking at expansion. Hasn't shown through yet. So let's see what happens there. But this is really now the outcome of this, and this again is the interpolation of the markets as to where interest rates are going to go. We'll look at the forward rates in a second, but really what you're looking at is treasury bonds that are trading in the markets for different maturities. Based upon that and where they're trading, you can interpolate how many rate cuts or rate hikes there are going to be. And I've circled things here in red so that you can see the effect of this. So this is last quarter. Always do this, one quarter to the next. So this is when we looked at this webinar last time, and you can check, it's the same graph. And for the end of October, which is what I've circled here, the markets were still pricing in 2 rate cuts. And a terminal rate of sort of 3.15. They're at 3.75 at the moment, and now they've taken off the rate cuts entirely, which is quite shocking. Now, Vijesh, I know you're burning for comment here, but I'm just going to stop you and have you comment on the UK picture, which is even more frightening. So let's just park that here. But this is certainly the real world effect of this war is the inflation expectations have changed, and now we're no longer getting these rate cuts, which have been driving these markets upwards. So here's the UK, and it looks a bit worse, Vijesh.
Yes, it does. So the US is I guess it has their own energy needs. They're an energy exporter. So as a result, although they do pay for higher oil price, they're much less exposed to natural gas, which is harder to transport. Whereas in the UK, we import everything. We import gas from Norway, from Qatar, and oil, of course, as well from the Middle East. So here we're at much more of a risk than the US, and we can see that in this graph here, which looks at the UK inflation expectations, and what we can see is that it's risen by 1.4%, almost to 4% now on CPI. Yeah.
Frightening. Before we look at the result of this, the UK growth has stagnated, so this is a bit mirror image of what we just looked at in the US. We're still above 50, but we'll need to see how that works. We have definitely gone down now in the first month, but this now is the frightening chart. Vijesh, take us through this one.
Yes, so previously, as of the last quarter, just like the US graph, we were pricing in around 2 rate cuts in the UK. So the Bank of England will be cutting twice, whereas now we are looking at almost 2 rate hikes, and also at one point it was showing almost 4. So that is really the real risk here, which might shock some of us, thinking how can the Bank of England possibly raise rates? But that's what the fixed income markets are telling us, that they probably will.
Have we ever seen anything like this? I mean, 4 rate cuts just poof in 1 month. I guess during COVID we had similar things, right? I've rarely seen a turnaround like this. This is obviously a sort of a event risk that you can't price into your models. But this has certainly now had a huge effect, not just in the mortgage markets, but also on growth expectations and earnings, as we shall see. Speaking of which, so far, we were just starting now. Europeans have started. They weren't great. Who do we have out? We had ASML out and
Hermes as well.
And Hermes, they weren't great, right? So as a first indicator that things aren't well right now, and as you always know, the effects of economic shocks always take a while to apply through. But for the time being, the consensus estimates is still that we're going to see an upward revisions to earnings. And this is the MSCI World, so this is mainly heavily US, but it's also the major economies in the West. So let's see how that works. Which brings us to performance. So just to summarize very quickly, we had this huge shock with the war in Iran. Things were going swimmingly for January, February. We had a lot of positive green shoots. Growth was turning up, inflation was being beaten. The world was okay. Then we had this big shock, and now it's all that matters. And we'll see, why when we're now going through these different asset classes. So what we want to do now is, having looked at the drivers, is all driven by geopolitics at the moment, and later earnings. So now, how does this manifest itself in the actual price performance of the major indices? So we start with the S&P 500, as we always do. It's the biggest market in the world as far as traders are concerned. And you'll see that I did this chart yesterday, and it's already old, which is the danger in fast-moving times. So the S&P is now above 7,000. But yesterday, we were still below 7,000, below this all-time high. And I suppose, we're in trend. This is, the Liberation Day tariffs, which shocked the markets. Interestingly, on the war in Iran, we've got a similar picture, but not as much. So the markets kind of have learned their lesson. They're sort of forward-looking. But, on a regression, and this is just a 2 standard deviation regression, the markets, ever since the lows in 2022, they've been in this upward trend, and even this war doesn't seem to have done any damage to this trend. It looks a little bit different in Europe, and as you alluded towards, Vishesh, that has something to do with energy, right?
Yes, exactly. Just higher costs in Europe and higher prices.
So interestingly, Europe was ahead at the beginning of the year. We'll have a little bit of chat about that later. And so they also got disproportionately hit now. Traders take profits in the things that have gone up a lot. So that's one effect here. And the other effect, of course, is that Europe's being hit harder than the US. So we're just still hovering well below this all-time high that we made just a short month ago. Now, the UK is an interesting picture, Vishesh. Again, please enlighten me as to how to interpret this very busy chart that you've put together here.
Yep. So there are 2 indices here. In blue is the famous FTSE 100, which tracks, of course, the top 100 companies listed in the UK. And in white, we have more of the mid cap, so the FTSE 250, which is the 250 companies below those 100. Now, the FTSE 100 is more, your big international companies, the likes of HSBC, AstraZeneca, etc., and also some energy-producing companies as well, such as BP. So that's done quite well in the last year or so. Whereas
up 30%, the FTSE in 15
months. 30%, yeah.
Again, for someone who's watched the FTSE for the better part of 3 decades and, got used to sort of these pretty pedestrian returns, that is amazing. Don't know how else to describe it.
Yeah, the last year has been great. I think if you were to look further back, then less so, of course, where the index was basically flat over 3 years. But yeah, the last year and a half or so has been great for the FTSE. But sometimes we need to zoom out a little and look at the bigger picture.
Yeah, there's some currency effects here as well. So I think half of the currency exposure of the companies in the FTSE 100 are ex-pound. And I think 80% of the FTSE 250 is pound. So you can also see a bit of the currency effect here as the pound has strengthened. Another interesting chart this is emerging markets. So this is the emerging market index, the EEM, very famous. We've got 4 lines here. Vishesh, take us through it, please.
Sure. Yep. So as Christian said, this is the emerging markets. Now in purple, we have the South Korean KOSPI, which has a high proportion of semiconductors, which, as we can see, has been fantastic over the last year or so, up 137%, if you can believe that.
Why did we not put all our money into that?
It's a big part of the emerging markets, I suppose, whether you agree with that definition or not.
So we're long, it's just not enough, right? Yeah.
We are long. In white, we have the general emerging markets index, which is still doing very well, up 46%. However, in blue, we have China, which hasn't done quite as well. It has held up much better during this conflict, but still over the last year hasn't done great. And then actually in India, even worse, they're actually down in dollar terms over the last year. on weaker earnings momentum, etc.
So that's quite interesting because we look at India every day, and for a long time though it just never went down. It was our favorite index, right? It kind of looked at South Korea, even on a long-term basis. So it's interesting that has now, got done nothing for the better part of the year. Interesting. Obviously, a lot of currency effects in this one as well. But there's a huge. The point being is that it's a huge differentiation whether you invest in South Korea or in China or in India, and that's what we wanted to show here. Obviously, these regions are affected by the war just as much as anybody else, and some more so than others. The dollar, yeah, it's been interesting year for the dollar because in the first quarter we had to sell America, the reserve currency is over, we're all going to trade in bricks. It's going to go to 1 against the pound, and then we had this huge turnaround because during a time of war and crisis, people reverted back to safe havens, and now that the markets are pricing in that a diplomatic solution is at hand, the dollar has come off again. I haven't even bothered to put in a trend line here. Where do you see the dollar going, Vijesh?
Oh, it's anyone's guess, isn't it?
And there's a reason
it's not done yet,
well,
but
yes.
as we've spoken about ourselves,
Yeah.
is that with the war, tankers paying for oil in yuan, which has been a big change. Maybe there is a bit of a shift, but these things are so hard to call in the moment.
Yeah. This is the short-term gilt yield. This is the 2-year gilt yield. So these are bonds trading the market. These are the yields. And this is now where we're seeing a big effect. So that's what we alluded towards in that rate cut scenario. So this is actually where we're getting our information. Current rates are 3.75. The 2-year rates are trading at 4.26. That means something has to happen. So this is where we're getting this rate cut implication from. Interestingly, long-term treasuries, these are, this is the 10-year treasury yield. That's been relatively stable. Now, the reason that, I'm a bit surprised that it hasn't done anything is because usually the 10-year yield is very indicative of sort of risk on, risk off. People either buy or sell the 10-year because it's a leverage play on the fixed income markets, and it hasn't done anything at all. What do you make of that, particularly with short-term rates moving as much? Long-term rates haven't moved. What gives, Vijesh?
Yep, I think the markets are telling us that the inflation kind of debate is short-lived here, and any effects will be pretty transitory, dare I say that term, from 2022, but that's what the markets are telling us.
Interesting. So this is all done now, right? So it's over. I don't want to take it away. We're going to get there in a second. Speaking of surprises, for those of you who've listened to me waffle on about gold for the last 6 years, I have this love-hate relationship. And the reason I do is because it never does what it's supposed to. So in the phase that we were in prior to the war, gold was just on a tear. It was up, almost 100% in the last 18 months, I believe. So this is just going back to last year. And then surprisingly, the reason that we buy gold is because it's supposed to be a safe haven and protect us in a crisis. Then the crisis comes, we're down 20%. So can you shine some light on that, please, Vijesh? Because I still don't understand.
Yeah, I mean, gold's kind of seen as a safe haven, but when the going gets tough, the tough gets going, right? So what happened here is, it's a very liquid instrument. You can easily sell it, and it just meant that if there's a rush to liquidity, it's one of the things that gets sold first, and that's exactly what we saw. It's since rebounded, funnily enough, along with equities, right? So yeah, it's one of those things which buy the rumor, sell the fact, I guess.
I suppose there, just to give credit to gold, there were other things going on. In the run up to the war, we saw central bank buying. We've seen central banks selling now because they need money, right? They need to support the energy crisis. So that's one effect. And then of course gold's gone up a lot. So if you're a trader and you're locking in profits, that's what you sell. So I'm not calling the end to the gold bull run here, but I'm just pointing out that if you're looking for this to save you in times of adversity, it doesn't always work. Speaking of which, here's crypto. The other surprise, again, I don't know which was the bigger surprise, that we had this run up in Bitcoin up to 125,000, or that we've had this massive sell-off, which happened, long before the war. And then during the time of crisis, during the war, it's actually been positive. So again, difficult to make sense of this. But the only reason that we came up with, and the reason that cryptos didn't go down anymore, is that the sellers were done. So as we went from 125,000 to 70,000 before the war, anybody who wanted to sell has sold. And that's the thing about the markets. It's not necessarily what the valuations are telling you. It's also what the positioning is like, which is why we look at it for our outlook. And we'll get to that in a minute. But again, interesting. I wouldn't have expected this. If you had told me that, we're going to have a war and gold's going to go down and crypto up, I would have said, yeah, run me through that one again. But here we are. And that brings us to the main event. And this is oil, which is probably the only thing we're looking at or should look at. This is Brent, which is the one that passes through the Strait of Hormuz, the one that's most effective. And as you can see, it's a big breakout. We had this is the war in Ukraine, which nobody seems to care about anymore, by the way. That caused a huge energy crisis, not just here in the UK, but elsewhere in the world. And since then, we've come down. And, it's not surprising that with the oil price going down, inflation has come down, and that sort of fueled these rate cuts and these expectations that markets will go up. Now that's reversed, and it's kind of a big deal. And the question is, where is this going to go? And Vijesh has got some magic answers because we have a secret way of looking into the future. Is that right, Vijesh?
Exactly that. So what we can see on this slide are the kind of future expectations of oil prices. So at the moment, when we see the headlines, we see gold, oil above 100, but that's just for a certain month. Whereas if you look further out, because you can trade by different months, in December we're actually only seeing oil at around $80 a barrel as opposed to around 100, which is what it's at around now. So again, this is a sign that markets think that the conflict will be relatively short-lived and that there shouldn't be too much of an impact on kind of more medium-term supply chains. But it really, again, one of anyone's guess. A lot of it is about positioning and, of course, what happens next.
So this is, again, as we're looking to the future, this is where people put money where their mouth is, right? So people are trading these instruments at these levels. You can lock in these prices if you buy these instruments. So this is like polymarket in a lot of sense. This is not just somebody picking something out of the air. People are actually trading here. And right now the oil markets are clearly telling us that it's transitory. Let's see, which brings us to our outlook. And we're doing well on time. And by the way, I forgot to mention, but if you have questions, we will get to you. There's this little box at the bottom of your screen, and Hannah is standing by. And as you put these questions in, she will then give those to us in the webinar, and we'll try to answer these as best as we can. So we've looked at the drivers of the market. It's all about the war. We've looked at the charts. It's all about oil. So let's see where this thing is going to go now. And we start with the US labor market, Vijesh, which incidentally is also a positive in some sense. Run me through that.
Right. So what we can see here are the monthly changes in US payrolls. So from the start in 2021, the job market was booming in the US. That has gradually come down, on higher rates, just a weaker economy, I suppose, in general, maybe effects of AI here as well. So now we even have some negative months in payrolls where people are actually having layoffs or companies are letting people go. The good thing about this, I suppose, is that it means that the economy is weakening, so rates might not, quite stay as high because central banks need to support the economy. Lower rates are good for that, and as a result, these kind of different forces. One is supply chains pushing rates up, but the other is a weaker economy pushing rates down.
Amazing. And this might be a chart that only interests me, but I just found this interesting. I always get excited when charts go back to 1939. So this is the percentage of private sector jobs versus government jobs. And what you can see here is that in the US, predominantly the private sector has been what's growing, which is usually a sign of productivity because government jobs usually aren't as productive, if I dare say that. How does this look in the UK, Vijesh? Do we also have a larger private sector growth here in jobs than in public markets?
Not quite. Yeah, I did my research here. So a lot of the job growth here has been in sort of the health and social care sector, which I suppose in the US actually is private, and that has driven a lot of the growth there as well.
Okay.
A lot of it is, healthcare related, and aging population, et cetera, et cetera. But the share of private jobs has been coming down, just as a function of higher costs, whether it be national insurance, higher minimum wage. Exactly.
So it's the exact opposite of the US, the UK. And I'll let the listeners make their own interpretations what that means. Unbeknownst to all of us who were all caught up in this AI bubble, which nobody seems to speak about anymore because, it's all about the oil, but it seems to continue. So again, very busy chart, Vijesh, if you could just clarify that a little bit, that would be great.
Yeah, sure. So what we're really seeing here is there hasn't been too much of an impact of AI so far. It's kind of being put more into the future. So in green, we have 2025, and what we can see is in terms of expected impacts, there's a lot more going on in 2026. So whether that comes to fruition or not, I guess we'll have to see. But yes, so far AI, we're starting to see things, but maybe not quite the uptake that people have expected so far.
Okay, but the revolution continues.
But it continues.
Another interesting chart, and this will come as a surprise to many participants as we now look at the other charts. So this is an attribution analysis essentially, and we've looked at the returns of the S&P. Again, apologies that we're looking at mainly US data, but it is still the global superpower, and about 60% of market activity, and we get good data from the US. So we tend to look at US data, but don't worry, whatever happens in the US happens in the rest of the world. So always good to look at the primary market. And if you're looking at the primary market, then it's good to look at the S&P. And what we're doing here now is we're looking at the returns of the S&P, which up until this chart was made were negative. And you can see that the drivers of the returns have come mainly from PE multiple contraction. Do you want to explain what that means, Vijesh?
Sure. So in terms of valuations, generally the main one is that stocks are priced on their earnings, so as a multiple of their earnings. And what we're seeing here is obviously equities had to come down at this point. The S&P was down 5% when this chart was made, but in fact, earnings expectations for the next 12 months had actually increased by 5%. So in some way, the S&P had actually gotten cheaper by 10%. To at which point this chart was made.
And that is why we've now seen, things like this, where on a forward PE basis, a forward-looking basis, the technology sector has now come back in line with the rest of the S&P, which is incredible, right? Because, tech was certainly trading at a premium. So that's one manifestation of, the fallout from the technology sector having just gotten obliterated in the first quarter, and it's also done wonders to the valuations of the US versus the rest of the world. Now this is the PEG ratio. This is not just PE ratios, but it's the PE versus growth ratio. Rule of thumb: if you have a PE, a price earnings ratio of 20, and the company earnings are growing at 20%, then that is a PEG of 1. And that's kind of what you're looking for. Then it's fairly valued because you're getting the growth for the valuation. And whereas the US had this huge premium, and this again is why you have to look at this in more detail. If you just look at headline PE ratios, the US is much more expensive than Europe. I think the average PE for the S&P is around 22, and for Europe's around 15. But of course, they're growing at a higher rate. And that's why you can't just look at PE ratios in isolation. You have to also look at the underlying growth. And what we're seeing here now is that the US is no longer expensive, which is, quite amazing given the premium that we've had on this. Speaking of earnings outlook, these are the revisions, Vijesh, right? So that's a bit different than just the expectations, but the revisions have it in them because that kind of gives you the latest outlook, right?
Exactly that. So what we're seeing here is in the US, albeit at a slower rate, but earnings are still being revised upwards. So the smart analysts on their laptops are saying, okay, actually Nvidia's earnings are going to be even greater than we expected, and they're just increasing those. Whereas in Europe, the opposite is occurring, where actually they're being downwardly revised. So the likes of maybe SAP, etc. Hermes, as we saw in earnings today, are actually being revised down lower due to higher costs, etc.
Yeah, interesting. We still have a debt problem, which is obviously not going to get any better, which was what's happening now in the Middle East. This is quite frightening, and that's because when you have, what is the U.S. debt right now? Is it 40 trillion, 39 trillion dollars, something like that? When you're financing that at zero, that's one thing, but when you're paying 3.5 or 4%, it's quite another. And in the next year, the US has to roll some of that 40 trillion, so the tune of $10 trillion. And whereas before that was being financed at lower rate, it's now being financed at higher rates. And that's what this chart here is so frightening, that for every $5 the US government collects in tax revenue, and it ain't small, $1 of that goes to paying interest on debt. Scary stuff, and that is expected to increase. This is the damage from the oil price. Obviously the inflation that we've just saw on the interest rates are a function of the oil price. So this is more specific now. And this chart looks at what the sensitivity of GDP in particular countries versus a 10% rise in oil prices. I think it's pretty self-explanatory. Clearly, countries that have oil, like Russia and Brazil, it's good for them when the oil price goes up. But then for the countries that are importing oil, it looks nasty. And the one that I want to highlight here is China, because they, of course, import not just a lot of oil, but also a lot of oil from the Middle East, and that passes through the Strait of Hormuz. So you can see how all these things are interconnected, and probably have a bit of sympathy now for the AI that it couldn't figure out what was going to happen. This is also the war damage by sector. Vishesh, any smart comments on this chart?
Yeah, I mean, unsurprisingly, likes of airlines and I guess the more intense or capital intense businesses and energy intensive businesses are the ones hurting the most.
Yeah.
Whereas the likes of telecommunications, etc. That's good for them.
Yeah. Positioning. As we said before, when we looked at gold, how traders are positioned has a huge bearing on where the markets will go, regardless of valuations. So this I think tells us that people have sold a lot of equities, right?
Yeah, exactly. So we were elevated positioning wise. A lot of people were long going into this. So as a result, when everything started to kick off, people started selling, and there was a lot to sell.
But it gets worse because.
So this chart here shows the amount of shorting. And what we can see here is there's been a lot of short covering, essentially. So a lot of people were maybe short after the war or after the war began on kind of bets that this was going to be a very long conflict, and they'd have been making some good money when equities were down 10% or almost down 10%. Whereas now that we've had this big rise and all these tweets about peace deals, etc., and ceasefires, it means that people have to cover their positions because they can lose a lot, and this forced buying as stop losses are triggered as people need to buy back their equity positions, means that a lot of these upward moves can be sort of overinflated, and that's what we've also been seeing in terms of some of the companies that were kind of most shorted. It's up 20% in the last 2 weeks alone.
It's frightening being short. This chart here. If you're a fund manager and you're holding equities, and then you get nervous and you sell them, that's one thing. I mean, you will then itch because you want to get back into the market, but you're not hurting. If you're short, then your potential returns are infinitely negative, right? If you're short at 10 and it goes to 100, you're down 9 times your money, and that psychology is what leads to these huge short covering rallies. Because when you're short, you just have a completely different mindset than if you're flat. And the thing is that you expect the things to go down. So at the first semblance that it doesn't, you start covering, then the next guy starts covering, and then the next guy starts covering. And you've ever seen stocks like GameStop, for instance, which is the most famous one, which I think was up 3,000% in 1 month. It was a heavily shorted stock because the company was going bankrupt, and then some meme traders got a hold of it, started taking it upwards, and then one by one, everybody had to cover, regardless of the level, because you just got to get out. And that's potentially why we're seeing this market now being where it is, but I don't want to get ahead of myself. But this just tells you how extreme the positioning was as a function of this war, and what can happen now on a dime when things change. This is another interesting contraindicator. So the shorting is always a contraindicator, right? When people are short, you expect the market to go up. When people are long, you expect the market to go down. And this is kind of very similar. It's our favorite chart. We have this in here, every time. It's from Bank of America. What do you make of this, Vijesh?
So at the onset of the war, as people started getting scared about how long term these effects might be, we saw a lot of people selling like equities and bonds and going into cash. So we've seen a big spike here. Now, obviously, this is backwards looking data, so we don't quite have the most recent numbers here, and I would assume that figure has dropped quite a bit.
So again, what we're circling here are instances where people went into cash in large numbers. And if you then interpolate these dates, so December 08, October 22, these instances then also coincided with the bottom. We bottomed in March 09 and we bottomed in October 22nd. And ever since then, it's been this massive bull market. So very interesting chart, this. And what it's telling you right now is that we're a bit neutral. And that's probably a good thing. But we haven't reached the extremes where you expect people to just pile into the market because the crisis is over. The other thing we have coming up are the midterm elections. They're in November, and it's one to keep in the back of our mind as we're looking for an outlook. Now, this is from Polymarket, which apparently nowadays is where all the smart money trades. And at the moment, given that what has happened, the voters in the US aren't necessarily happy with the direction of the country. First of all, things are more expensive. We're in another war, and these were, of course, the tickets that Trump won the elections on. Is that we're done with the forever wars. I'm going to make things more affordable. And despite the rhetoric, people are paying $4 and $5 at the pump. So, right now the poly market is indicating, and again, these percentages are interpolated from the amount of bets that people have taken out, and there's quite a bit of money behind this now. At the moment, the markets are pricing in a sweep for the Democrats, more so in the House and in the Senate. That's because there's only so many number of seats that are up for grabs every 2 years. But this should definitely give the Trump administration pause for thought. And you would also think that whatever happens now, between now and the next elections, this is going to be on their mind. Sentiment, this has been a lot worse. Vijesh, you want to run people through the sentiment at the moment? And again, it's a bit of a contraindicator, isn't it?
Exactly, yeah. So this is a bit of insight into sentiment, how people are feeling. We go from extreme fear all the way to extreme greed. At the moment, we're at a 41, which is fear. I believe there are times in the last few weeks where we were, much closer to that deep extreme fears.
I think we were 8 or 9 at one point.
Yeah, 8 or 9 exactly. Yeah. Which, as Christian mentioned, is a bit of a contraindicator because sometimes when people are most fearful, it means people have sold, and that often presents good opportunities to get involved as buyers.
So almost neutral now, which brings us to our conclusions. This is a new feature, by the way. As you know, we don't take views here at Blue because the future is pretty difficult to predict. I mean, we'll obviously look at positioning and various indicators in the market to get a short-term idea of where the market may go as traders. But we have no idea what's going to happen 1 or 2 years out, and nobody expected COVID for that instance. So really, what we're trying to do is interpolate what the market's telling us, and this is a chart of the S&P, which is the one that we look at most often. It's also one that we bet on a daily basis in our little daily call here, and it's also what we ask the viewers, of course, to vote on every quarter. And the first takeaway from this chart is that we got to get a hobby because we're obviously looking at these things a bit too extremely. So there's a lot of lines here. And it tells us, how busy we are with this. But this is where the S&P is right now, and it's kind of telling us that this war is over, right? Because that's where we were before the war. That's where we are right now. What's your feel, Vijesh? Where's this thing going to go now?
That is an impossible question.
No.
But yeah, no, the market's definitely telling us it's over. Again, some of this might be positioning based. I mean, at the end of the day, there's not really any oil flowing through the Strait of Hormuz at the moment, as well as other things. So that's not great. But markets are forward looking. They think with all these promises of ceasefires and peace deals that this is going to be over quite soon, and as a result, earnings are still going up. So why, what's the problem? Let's next step 8,000, I guess.
It's just incredible. And having done this now for 30 years, I've traded these markets for 30 years, particularly this index, because back when I was starting out, this was one of the few instruments that you could trade, almost on a 24-hour basis. And it still is impossible to call. I would have never expected, first of all, the markets not go down as much as we did in April, because the energy shock, as you saw, was the same. And, the risk of this escalating is obviously much greater now. So that was a surprise to me. I thought we'd go much lower. And now the fact that we've priced this out to such an extent is shocking. I suppose it has a lot to do with the positioning. People were short. It hasn't happened. People are very worried about being caught offside here. But we have seen real money flows into this. There's real volume behind this. But there you go. This is where the cookie crumbles. And, ladies and gentlemen, there you have it. The equity markets are telling you the war is over. Which brings us to our poll. And it is now up to you, dear listeners, to tell us what you think is going to happen. We gave you many clues as we could. The first thing we want to do is go back to last quarter's poll. So, we also asked you last quarter, will the S&P go up or down? 72% of us thought, and I did too, it was going to go up. And survey says it's down. Who would have thunk? So this is the end of the quarter, which was, 16 days ago. Clearly we're at 7,000 now. So you have to excuse us. We always do it quarter to quarter. So just remember that when you're doing your vote. It's not where we are today. We're not that sophisticated, but we obviously all got this wrong. The next question we asked you was silver. And as you might know, as you might recall, in a time long ago, silver was all we talked about. Yes, I know these were great times. And, it went to this all-time high. And we also asked then the audience whether we thought silver would go up or down. And 66 of us educated listeners, myself included, thought it would go down. And Hannah, where's the result? Hannah, we missed it. It just went up. So silver was up at the end of March. I guess it doesn't lie. I guess we were all wrong. It is certainly lower now, but I guess it depends upon where it was at the beginning of the quarter. My apologies, Hannah. I shall never, question you again, but there you go. So for this month, for this quarter, again, if you could now please all give us your indication of whether the S&P is going to go up or down, and you will see this little box come up now. And if you could please give us our expectations there. 75% of us think we're going to go up. So I guess the war is over. Fantastic. But before you go away, I'm also going to ask you, is oil going to go up or down? And so I would suspect that if everybody is expecting the S&P to go up, that oil is also going to go down. So you also give us our vote there. And smart audience, very smart audience. 87% of us think it's going to go down, which makes perfect sense. Before we get to the Q&A, just a reminder again to stay in touch with us. We'd love to hear from you. So, in case you haven't signed up for our distribution list yet, we bring out weekly insights where we pick up the story from the week before. We put 250 very cynical and short words around it, quite educational, quite entertaining, and it keeps you up to date with the main things that are happening. We also have a monthly newsletter, and of course, we have these quarterly webinars. And without further ado, Hannah, if you could please let us have any questions, if you've forgiven me, that is.
Yep. Our first one is the increasing debt level in the US a concern for the markets?
That's a very good question, which is why I'm going to defer to Vijesh. What do you think, Vijesh? The increasing debt, was it Dick Cheney? He said deficits don't matter, right? But the debt levels, it's got to be a problem, right?
It doesn't. It doesn't. I mean, what we've seen recently in the last few years, clearly it doesn't seem to matter. Providing the US can keep paying this back, but if we do see rise, if that kind of increased debt level also snowballs into higher yields, particularly on the longer end, then yeah, that would obviously be a bit of a strain for markets. But at the moment, I don't think it's an immediate concern.
So we have this discussion a lot, and I always bring up Japan, which of course has a much higher debt to GDP ratio than even the US. The US right now is around 110%. They have more debt than GDP, and Japan is around 250%. But Japanese interest rates are low. So they've just been funding this, but they've been doing this for 30, 40 years right now. What do you think would happen if the US debt to GDP ratio went the way it was going to go to Japan? Can they afford that? So right now they're spending $1 on every 5 to service 100% debt level. If that goes to 200, then you're looking at $2 or $3, and half the US budget goes to paying interest. That can't be healthy, right?
I mean, probably not at the same level. I mean, the thing about Japan is, yeah, as you said, they were at much lower rates, whereas those rates have come up pretty considerably in the last few months. So maybe that could provide us some insight of what's going to actually happen and the eventual burden on the economy there. I think that would be actually a very good example for us to look at.
Okay. So the answer to the question is, let's look at Japan, see what happens. Right. Next question, Hannah.
Have you changed portfolio allocations as a result of the significant upward shift in expected interest rates coming down the track?
Well, that kind of answers the question. We have indeed, and that's because the environment has changed. Particularly with interest rates moving as they have, that always changes our bond allocation. Beyond that, Vijesh, have we had any great changes to our outlook and positioning?
No, I mean the rate cuts being taken off the table is obviously quite surprising. But if you look at the longer term rates, which mostly actually drive the performance of the bond portfolio, they haven't been quite as extreme. So a lot of the damage was actually done on the short term part of the curve, which also translates into lower effects into the price of the bonds. Having said that, we have also been increasing bond allocations a little bit to take advantage where there is
on the short end.
On the short end where available,
yeah. Beyond that, obviously the allocations to different asset classes are a function of the client's risk profile. These are just something that we balance systematically. So as things moved around, we did rebalance opportunistically. We sold some bonds and bought some equities when equities were down. Beyond that, for the moment, we haven't made any great changes to allocations. But as we discussed, that may change in the future. But opportunistically right now, we like short-term rates. They're quite high. You're not getting rewarded for it on the longer end, so that's where we'd probably exercise a bit more caution. Hannah?
Where do you think European equities now go versus the US?
Yeah, that's been the million-dollar question. We've seen patterns here, and this is something again that Vijesh pointed out. It always seems to be in the first quarter that European equities come in vogue, and then you have this massive outperformance, and then it stops in March, right? Now, obviously, we didn't have a war last year, but we also saw now what happened in the last week, which surprised me. On this expectation that the war will end, it wasn't the European equities that went up, which you would expect because they got sold off more and they're going to be benefiting more from these lower oil prices. It was the US that just rammed up. And I love to look at the difference between the Euro Stoxx 50 and the S&P 500. Have a look. We just take the difference, in the price of the indices. And at some point, I think last year in the first quarter, the S&P was 1,200 points above the Euro Stoxx 50. And that's been kind of, the normal business. Then in this massive rotation last year, that difference went down to 150. The Euro Stoxx 50 was almost at the same price level at the S&P. And now in this crisis, in this latest bound, we didn't quite get that huge dispersion. I think that the narrowest it was around 750. and now it's back to 1,050. That's just a bit of history in terms of what these markets have done. Going forward, and this is a discussion that we have a lot here, which is why I'm so excited to talk about it. So very good question to ask. Going forward, there's two things at play here. I think one is the rest of the world is really fed up with US policy. We've gone from the US being, a safe haven and a force of stability around the world to now with these trade agreements and these tariffs and the insults and the war. So it's quite understandable that the rest of the world wants to divest from the US. And this is where this European upswing in equities has come from. But if you say, fine, I don't want the US, but if you then look at the composition of the European indices, and this is always the argument that you make, what do you find, Vijesh?
So if we look at, say, the stock 600, for example, the top holding is ASML, which, to be fair, is semiconductors.
Great.
That's great. They create the machines. But second and third is HSBC and AstraZeneca.
Those beacons of global growth.
Exactly. Cash cows, I guess, so to speak.
There's no Amazon, there's no Apple, there's no Nvidia. Well, ASML a little bit to some extent, but that's what you're missing. That's the problem with Europe. And you also saw the earnings revisions are going down. They have an energy problem. They have a welfare problem. I'd like to buy Europe. I'm a huge European fan, but it's difficult on a 10 to 20 year view to now think that European equities are going to do better than US equity, disregarding all the volume. The other thing I want to point out, and this is what my colleagues in Holland always tell me, is, Chris, you're not buying Europe or the US, you're buying multinationals. They just happen to be listed in these countries. And that is very true. If you buy, Apple or Nvidia, a lot of their earnings are derived from overseas. So you're not buying a US company, you're buying a multinational company. And that is interesting because they not just are listed in the US, but for the international business, they also have international operations. And so these things like the H1 visa restrictions in the US, for those of you who don't know that, that's how international students study in the US. I was an international student in the US, so I had an H1B visa, and that allowed me to study in the US for 4 years, and then you get 1 year of work experience, and then they kick you out. But it's been a huge attraction for foreign talent to come to the US, study there, then prove themselves to these companies, and then be employed there permanently. And that's obviously where all the tech talent has come from. So I thought, oh my God, if they now restrict this, you're going to have a huge dearth of talent come to the US, which is bad for the Americans. Vijesh, what did Google do when this happened?
They opened up a new office in India. Stop bringing them over. We'll just build an office there. I mean, at the end of the day, the Google itself as a company, they didn't really mind.
And that's why these regional allocations are not as important as you may think. The currency allocation is, but again, how much do they hedge? How much is derived from abroad? But that's why we don't get too caught up in these regional allocations. It's more about the companies themselves. And don't forget, there are also some European champions like Spotify, which is one of the few tech companies we have. They're European, but they happen to be listed on NASDAQ. So long story short, I don't see it. I don't see European equities now going on a flyer and making back this valuation gap that we've seen. This performance gap that we've seen, particularly also with valuations now coming more back in line with the growth. Do we have time for one more, Hannah?
Yep. Besides the war, what else do you see as the biggest risk for the global economy?
Oh, wow. Is there anything other than the war? Vijesh?
I suppose there have been a couple of things. Obviously, there's been the threat of AI. But also,
we dealt with that already, right? Did we deal with that?
I think so. I think so. The market seems to have forgotten about it. Then also there's private credit. That's obviously what was in the news before the war. A lot of people trying to get out and have been able to, as these things are private.
Walk us through the private credit bubble, because we've been there before. We had one previously, and now everybody seems to have forgotten about that and piled back in. So why is private credit in trouble?
People just want liquidity, and because these funds are kind of sold as being relatively liquid. People don't really foresee any lockups, but if too many people want the money out at one time, it means the liabilities that the funds have, that's not daily. It could be monthly, quarterly, semi-annual, or whatever. So it's just an asset liability mismatch there.
So it's less about problems in the private market sector, because remember, these are private companies who are issuing credit, right? It's not unlike Vodafone issuing bonds. You have a big private company, they're issuing debt, and people can buy that directly. So it's not a problem with the creditworthiness of the companies themselves. It's just how people get access to these credits. Is that correct? Is that, particularly now in a time of war, people want to get out because they want their money and they can't, and so then these funds get gated, and then it becomes a self-fulfilling problem.
I think it's a bit of both. I think it's mostly the liquidity thing you just mentioned. I think some of the maybe credit was a bit too overvalued as such, but I think those have also come down in valuations, which probably led the liquidity as well in the first place on top of the war. But as you said, I think it's probably mostly a liquidity crisis at the moment, as opposed to anything else.
Great. Well, there you have it. Hannah, unless you have another burning question, I'll wrap things up.
No, that's all good. Okay,
fantastic. Well, thank you so much for listening. Our audience keeps growing, so thank you so much for listening to us. We'll see what happens. Obviously, get in touch with us if there's anything you'd like to discuss. Do sign up for our distribution list and let us know what your thoughts are, and we'll see you again next quarter. Thank you very much for listening.
Thank you, everyone. Cheers.